What's going on, everybody? This is Coach Wade, and today I want to explain one of the most talked about investments in the world, the S&P 500 Index Fund. Now, if you've been learning about investing, you've probably heard someone say you should look into an S&P 500 Index Fund. Maybe you heard it on YouTube, read about it in a book, or heard someone mention it on a podcast. But what exactly is it? And why do so many long-term investors choose it? Let's break it down. First, let's talk about the S&P 500. The S&P 500 is not an investment by itself. It's an index. Think of an index as a scorecard. Just like a scorecard tells you how your favorite sports team is doing, an index tells you how a group of companies is performing. The S&P 500 follows approximately 500 of the largest publicly traded companies in the United States. These are companies that many of us know, companies that make products we use, provide services we rely on, and play a major role in the U.S. economy. Now, here's where the index fund comes in. An S&P 500 index fund is an investment that's designed to follow that index. Instead of trying to pick just one company, the fund owns shares in hundreds of companies that make up the S&P 500. So when you buy one share of S&P 500 index fund, you're not buying one company, you're buying a small ownership interest in hundreds of companies through a single investment. That's one of the reasons so many investors like index funds. They're simple, they're diversified, and they're designed to follow the performance of the overall index instead of trying to beat it. Now let me ask you a question. Would you rather depend on one company to determine your financial future? Or would you rather spread your investment across hundreds of businesses? For many people, diversification makes a lot of sense. Because if one company has a bad year, the entire investment isn't dependent on that one business. Other companies in the fund may perform differently. That's one of the biggest advantages of diversification. Another reason people like S&P 500 index fund is because they generally have lower costs than many actively managed investment funds. Why? Because they're simply following an index. They're not paying large teams of managers to constantly buy and sell stocks trying to outperform the market. And over long periods of time, keeping investments costs low can make a meaningful difference. Here's another thing I like about index fund investing. It removes a lot of the guesswork. You don't have to wake up every morning wondering, should I buy this stock? Should I sell that stock? What company is going to be the next big winner? Instead, you focus on something much more important: consistency. As I've said before, the goal isn't to own the perfect stock. The goal is to become a disciplined investor. Now, let me be clear. An S&P 500 index fund is still an investment. That means its value will go up and it will go down. There'll be years when the market performs very well, and there'll be years when it doesn't. That's completely normal. Investing always involves risk. Past performance doesn't guarantee future results. That's why it's important to invest with long-term perspective. One of the biggest mistakes new investors make is watching the market every day. When prices go up, they're excited. When prices go down, they become nervous. But long-term investors understand something important. Daily market movements don't determine long-term success. Time does. That's why I often say the goal isn't to time the market, the goal is to spend time in the market. As I teach in stage 4 of the 7 stages to financial independence, the wealth building zone, this is where your money begins working for you. Once you've built your emergency fund, eliminated your consumer debt, and established financial security, now you can begin consistently investing for your future. I encourage people to work toward investing 15% of the household income for retirement. And one strategy many long-term investors consider is investing consistently in broadly diversified index funds, such as S&P 500 index funds, as part of an overall retirement plan. One of the best habits you can develop is something called dollar cost averaging. That's simply investing a consistent amount of money on a regular schedule. When prices are high, your money buys fewer shares. When prices are lower, your money buys more shares. Instead of worrying about finding the perfect time to invest, you simply stay committed to your plan. Now, here's what I want you to remember. An S&P 500 index fund isn't designed to make you rich overnight. That's not its purpose. Its purpose is to give long-term investors an opportunity to participate in the growth of hundreds of America's largest companies through one diversified investment. Simple, consistent, long-term focus, and easy to understand. I'm Coach Wade, and I believe investing doesn't have to be complicated. You don't have to predict the future. You don't have to chase the latest investment trend. You don't have to spend your life watching stock prices every day. You simply need a plan, the discipline to stay consistent, and the patience to let time work in your favor. Because remember, wealth isn't usually built by making one spectacular investment. It's built by making smart decisions over and over again for a very long time. And I'll see you guys in the next lesson.